Hey guys, Posh English Trader here, and in this video I want to take you through 3 steps to show you how to trade the double top and double bottom chart pattern. These patterns are some of the most common patterns to be found in the charts, but can be some of the most frustrating to trade, because whilst everyone will tell you that they are great signals to enter trades, the specifics of how are not very well explained. Well, in this video I want to change that and go into as much detail as possible, using real-time chart examples, with the aim of giving you a much better idea of how you can trade the infamous double tops and bottoms. But first, you need to understand what double tops and double bottoms actually show. So, the specifics of how you can use this to trade we will go through later in this video. But for now, you need to know what the double tops and bottoms show you, because without this knowledge you won't fully understand where to trade them and how. First of all, it is important to know that both of these patterns are what's known as a reversal pattern, simply because they indicate when the market has run out of steam in the direction that it has been travelling and may be about to turn in the opposite direction or reverse. So, the double top consists of 2 main parts, the support and the resistance area. It is formed by the market first of all rising and then being resisted at a level, giving us our first top. The market then falls back to a level but stops, giving us our support level, or what's known as neckline. The market then rises once more to again test the level set by the previous top. But again, it fails to break through and our second top is formed. What traders look for now is for the market to again fall and break through the neckline, which then signals that the market may be about to fall and traders will profit from that fall in price. The double bottom is exactly the same, but in reverse. So it is found at the end of a falling market, and the difference is that instead of looking for the market to fall after the pattern, traders are looking for the market to rise and then profit from the increase in price. In this instance, the B stands for bottom 1 and bottom 2, and the neckline would be the resistance area as opposed to the support area. So, now you know what double tops and bottoms show, I can take you through the 3 steps of how to trade them. So step number 1 is choosing which pattern to trade and when. So, amazingly, this is one of the least taught steps, but the one that is actually the most crucial. I'm going to keep it very simple. I'm going to talk about which pattern to trade in an uptrend, which pattern to trade in a downtrend, and which pattern to trade in a ranging trend. Let's start with the uptrend on the real charts. So here's a current uptrend on the pound Australian dollar, as you can see by the series of higher highs and also higher lows. Now the fact that you can join a trend line between those higher lows confirms that this is in fact an uptrend. Now when you have a trending market, it's always advisable to try and trade with the trend, simply because you want to try and trade with the majority as opposed to the minority. Therefore, ideally, you're looking to profit from the market rising or going long. Now what you want to do in this instance is look for a point at which the market has retraced back down towards that trend line and then met with it, as you can see just here. And you can see that this also meets with the horizontal support and resistance line indicated by this line just here. So knowing that this is a good place to trade, we're going to look for a double bottom right at this level. And the reason is that a double bottom signifies where the retracement to the trend line may have run out of steam. This means the market may be about to reverse and continue rising. So in a downtrend, it's almost exactly the same process, except in this occasion you're looking for a double top. So as you can see on this Australian dollar US dollar chart, the pair's in a downtrend, and we can see this from the fact there's a series of lower highs and also lower lows. So at this most recent high, the pair has retraced back towards that trend line that the pair has been respecting for quite some time, as you can see just here. So this is the point that we'll be looking for our double top to signify that the rise to the trend line is slowing down and that the market may be about to reverse and continue that downtrend. So a ranging market is interesting as well, because in this instance what you can do is look to trade the top of the range down to the bottom of the range, and also the bottom of the range up to the top of the range. And as long as the range continues, you can continue to follow this pattern. So in order to do this successfully, you'd be looking for a double top to form at the top of the range. This would signify that the price rise to the top of that range has run out of steam and the price may be about to reverse. In this case, you could sell the market and profit from the fall back down to the bottom of the range. In contrast, when the price reaches the bottom of the range, you'd be looking for a double bottom to form, and then you could buy the market and profit from the price rise back to the top of the range. So on this Canadian dollar Swiss franc example, most recently the price decreased down to the bottom of the range. So what we'd be looking for at this point is a double bottom to form to signify that the price is about to reverse and head back up to the top of that range. So now we understand which pattern to look for in which trend. However, the next question is, how do we actually identify those patterns? And that's what I'm going to take you through next. So I recommend starting out with the daily chart, as we have in the past few examples, just to clearly identify the overall trend that the market you're looking at is in. However, when it comes to actually identifying the pattern, I recommend that you go from the daily down to either the 4-hourly or the 2-hourly. So start out, and I recommend, and I do this myself, start out with the daily, identify the overall trend, then go down to the 4-hourly, and if the pattern you're trying to identify still isn't clear, then take it down to the 2-hourly after that. So that brings us on to step 2, which is identifying the pattern. So, unfortunately, in the real world charts, the patterns are never as clear as the textbook examples. Often, you will see that the tops of the double tops don't line up, and the same with the bottoms of the double bottoms. However, I'm going to give you a few simple guidelines to recognize them. The guideline for a double top is, the pattern is more valid if the second top is at the same height or lower than the first top. If the second top is higher, then it does not necessarily negate the pattern, but it does require a more cautious trade. This will be covered in step 3. With the double bottom, the same applies. If the second bottom is at the same level or higher than the first bottom, then the pattern is more valid. Again, if the second bottom is lower than the first bottom, then it requires just a bit more of a cautious trade. So now we're coming back to our charts to see if we can put this into practice and identify some double tops and double bottoms. So first of all, we'll start off with our pound Australian dollar chart, as we stated was in an uptrend, as we can see just here. So we're looking to trade at this point here where price has retraced back down to that trend line and also meets with that horizontal support and resistance line. So at this level, if you remember from before, we're looking for a double bottom. However, at the moment on the daily chart, it's not that clear whether there is a double bottom there or not. So what I recommend you do, as I stated before, is just head down into the 4-hourly chart, which I'm going to show you now. So now we can see the point at which price met the ascending trend line and the horizontal support and resistance line a lot clearer, as in this area just here. And it's actually clear that we can see a double bottom just here. So as price retraced and came back down towards that descending trend line, it stopped around about that 17,200 level. It then retraced back up towards the 17,800 level, giving us our neckline and our first bottom. Price then retraced back down towards that descending trend line, but this time stopped just above that 17,300 level, giving us our second bottom. So this is clearly our double bottom formation, right at that point where we're looking to trade, where the ascending trend line meets that horizontal support and resistance line, and also price. So similarly with the downtrend on the Australian dollar US dollar, we're looking for a double top at the point at which price has retraced back up to that descending trend line. So again, clearly it's not that clear on this daily time frame. However, what we're going to do is just head down to the 4-hourly time frame again. So here we can see a lot more clearly that after price retraced back up to that descending trend line, it's then bounced off, giving us our first top around about that 7030 level. It's then retraced back down just to above this 6950 level, giving us our neckline, and then bounced back off and retraced back up to that descending trend line. But this time it's gone a little bit higher than our first top, almost up to that 7050 level, giving us a higher second top. After that, it's bounced back off and began to now head lower. So the fact that we do have this double top right at this descending trend line suggests that this could be a good place to enter the trade short. So finally, let's have a look at our Canadian dollar Swiss franc range. So as we talked about previously, price has most recently decreased down to the bottom of this range. And it's at this point here that we'll be looking for a double bottom. This would show that the price decrease has run out of steam and that there may be a reversal and then a price increase, as we can see just here. So actually in this case, it's clear to see that there's a double bottom already formed at the bottom of this range, as you can see just here. So there's not really any need to zoom into the 4-hourly chart. However, I recommend it anyway because the 4-hourly just gives a bit more clarity on what's actually happening. So here it's really clear to see that double bottom formation. We can see the price has decreased down to around about this 7,350 level, giving us our first bottom. Price has then retraced back up to around about that 7,500 level, giving us our neckline. Price has then consolidated a little bit around that neckline before then decreasing back down towards this 7,350 level once more, giving us our second bottom. Now in this case, as you'll see here, the second bottom is lower than the first bottom. As I said, that doesn't negate the pattern, but it does require a slightly different style of trade, as we'll talk about in section 3. So whilst understanding how to identify these patterns is absolutely crucial, understanding how to enter and trade them is absolutely critical, because getting it wrong can really lead you to getting stopped out prematurely and needlessly losing money. So that brings us on to step 3, which is how to enter double patterns. So one of the trickiest steps with double tops and double bottoms is where to enter. There are essentially 2 possibilities to entering this pattern. The first, perhaps, is the most risky, but carries the largest reward. This method is where you wait for what I'm terming a stalling candle to form at the second top or bottom. This is a candle where the market has tried to move in a certain or both directions, but has failed to maintain the momentum, and so has a long tail or tails and a short body, such as this. It is called a stalling candle because it represents indecision in the market, and therefore a stall in price movement. If you want more information on how candlesticks form, make sure you check out my other video, Candlestick Charts for Beginners, which will be appearing in the top right of your screen right now. The general rule of thumb is that the entire tail of the candle should be at least twice as long as the body of the candle. The position of the body on the candle matters, depending on the double formation. For example, at the second top of the double top, you would be looking for the body to be towards the bottom of the candle, as this shows that the market has tried to push the price higher, but has failed, and so now selling pressure is more likely to take over. In contrast, at the double bottom, you would be looking for the body of the stalling candle at the second bottom to be towards the top of the candle. This shows that the market has tried to push the price lower, but has failed, and now buying pressure is more likely to take over. One thing I would caution against is entering the pattern at this point if the second high is higher than the first, in the case of the double top, or the second low is lower than the first, in the case of the double bottom. How to enter in this situation we will come on to in the next possible entry strategy. Let's go back to the charts for examples. So on our pound Australian dollar chart, looking at our double bottom in the uptrend, you can see that the second bottom is higher than the first bottom, as you can see just here. And here you can see that there is a stalling candle formed right at that second bottom. So this represents a really good chance to enter this uptrend. Now one thing I always do, and I urge you to always do as well, is use a stop loss. Now the question is, if you're entering this trade at this stalling candle as we've just talked about, where do you place your stop loss? Well, my tactic is to place it at the first bottom or the first top just below the candle with the longest tail. So you can see that that is this bullish candle just here. Now I recommend that you place your stop loss 20 to 30 pips below the bottom of this tail of this candle. So it would be 20 to 30 pips down from here. The reason is because the tail of this candle represents the lowest point at which sellers managed to push the market down. Therefore, if the market starts heading lower than here, then it may be that selling will continue, and to avoid losses it's necessary to get out of the market now. So now if we have a look at our Australian dollar US dollar chart, we can see that the second top of our double top is actually higher than the first top. Now this requires a slightly different entry strategy, as I've talked about before, but you can also see that we do have this stalling candle right at the top of that second top, and also the body of the candle is towards the bottom of that candle formation, which means that this is a good entry signal. So the second method of entry, and the one that should be used if the second bottom or top is higher or lower than the first, respectively, is to enter the market when price has moved past the neckline of the double top or bottom. This method is a little safer because you are waiting until you have further confirmation of the direction that the market is moving in. However, you are sacrificing the amount of gain you could potentially make. What you're looking for in this instance is for a strong bearish candle in the case of the double top, or a strong bullish candle in the case of the double bottom, which carries price past the neckline. Most importantly, the candle should finish its period past the neckline. If the candle pushes past but then retraces back, developing a tail, then it is invalid and you should not enter. So coming back to our Australian dollar US dollar example where the second top is higher than the first top, we can see that the point at which the market pushed past the neckline around this 6,958 level was this candle here, this relatively strong bearish red candle. So this could have been a point at which you could have entered the market. Now with this entry method, the stop loss placement is slightly different. Because the second top is higher than the first top, suggesting that the bulls may still have a little bit of buying pressure behind them, you don't want to put your stop loss above the tallest candle on the first top or the lowest candle on the first bottom if this was a double bottom. You want to put it above the tallest candle on the second top, as in here. So 20 to 30 pips above the candle with the tallest wick on the second double top. Now sometimes placing your stop loss here is going to be too great, either in terms of the amount of risk you have compared to the amount of capital you have in your account, or the amount of risk to reward ratio. So if your target level is at the same level as the distance to your stop loss, if you're placing it here, then that's not as good as having a 2-to-1 risk to reward ratio. So there is a second option of placing your stop loss in this case if you enter in this way. Now often what happens in the case of double tops and double bottoms is after the second top or bottom, as you can see here, when price retraces back down towards that neckline area, it will consolidate, as in here, before it then finally pushes below that neckline area. So what you can do is you can look to place your stop loss above the candle with the tallest wick in the consolidation area, which would be this candle here. So placing your stop loss 20 to 30 pips above this candle would give you a much tighter stop loss area and therefore a better risk to reward ratio. Now on the flip side, this does come with a little bit more risk because of the tighter stop. So what will often happen after these patterns have broken down past that neckline is they'll then retrace back up to that neckline area and then consolidate again before then finally breaking lower and then taking us down towards our target profit. However, as in the case of this pair, what's happened is price has retraced back up, consolidated, and then actually risen back up towards that resistance area of the double tops. So had you placed your stop loss just above the consolidation area on this pair, you would have actually been stopped out. Whereas if you'd placed your stop loss above the highest point of this top, 20 to 30 pips, you wouldn't have yet been stopped out. However, what also should be noted is that this pattern was following its normal pattern setup right up until this consolidation area just here. And you'll see that the highest point of this consolidation area, which was this candle here, didn't go above the consolidation of the neckline area just here. And therefore, if you'd put your stop loss above this consolidation area, then you wouldn't have been stopped out if the pattern had formed correctly and then decided to descend. It was only because of some different fundamental data coming out that pushed the price of this pair higher, back up towards that descending trend line. So realistically, your choice of stop loss placement, whether it be above the second top or above the consolidation area, is going to be based on your risk tolerance compared to the amount of capital that you have in your account, and also how much you want to risk compared to how much you can gain from your target area. So in the case of the Canadian dollar Swiss franc with our double bottom formation here at the bottom of this trading range, you can see that this second bottom was indeed lower again than the first bottom. So this is another example of where you would have waited for price to break past this neckline area around about that 7,480 level before you entered the pattern. So that would have been this candle just here. Now what you can see here is the consolidation pattern that we were talking about before formed just here, this time a little bit lower than that neckline area, but still around that neckline area. Now if you had entered at this green candle here and then put your stop loss below the candle with the longest tail at the double bottom, then you would have been risking around about 150 pips, which is fine. That's not too bad. That's going to be about 1.5%. However, if your target had been around about this 600 level here at the top of the range, then that's going to give you a 1.5 to 1 risk to reward ratio, which is not good. So if you put your stop loss just below the candle with the lowest wick on this consolidation area, which is this candle just here, you would have been able to get a 2 to 1 risk to reward ratio, which would have been much better. And that's what I mean by looking at your risk to reward ratio to decide upon where you're going to place your stop loss. Also, in the case of this pair, you can see that the pattern formed correctly. So after that break of the neckline, which was just here, the price then retraced back down towards this broken neckline area, consolidated a little bit, and then rose up towards the top of that range. Okay guys, so you've now learned which pattern you should be looking for based on the trend, how to identify double tops and bottoms, and how to enter them, and where to place your stop loss. Although this is a great strategy to enter trades, you still need a base strategy on which you can add the one in this video. That's why I have put together a 100% free ebook for you called the 3-Step Trading System, which details the strategy that I use to trade successfully in the markets. Simply go to www.poshenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar www.poshenglishtrader.com/3steps or simply click on the link in the video description below. Also, don't forget to subscribe to my channel to make sure you don't miss any of my future video uploads, hit the like button to let me know what you think, and comment with any questions you might have. I will always try to respond as quickly as I can. Okay guys, until next time.